Hello everyone, and welcome to today's Demica webinar, Understanding the New Payables Finance Disclosure Rules. My name is Dan O'Hara, I'm the Marketing Director at Demica, and before we get into the webinar proper, I'd like to go through a couple of things with you so you know how to participate. Firstly, some housekeeping. You're using your audio, computer audio to listen to the webinar. You are all in listen-only mode. In terms of submitting questions, we'd really encourage you to do so. You can do that by the question pane of your control panel. You can do that at any time through the webinar, and we'll come to those questions at the end. We'd love to get your participation, so please do think of some questions for our experts. Finally, the webinar is being recorded, and for anyone who registered for the webinar, they'll receive a link to the recording within 24 to 48 hours after session. Before we get into the content, a final request from my side. At Demica, we're really proud to be running the second of our annual benchmark surveys for banks in trade finance. We ran the first of these last year and got close to 150 respondents from banks all around the globe. The resulting data was pulled together into a really comprehensive report on the state of our industry. As you can see on the slide, we addressed issues ranging from technology transformation, ESG, product design, growth expectations, and more. And we're doing the same again this year. And the richer the data set we collect, the more comprehensive the report will be. Given the level and the scope of the people on the call today, we'd really love it if you would participate. So I'll be shortly dropping a link into the chat to take part in the webinar, and as I said, we really appreciate your participation. So with that, I'm really pleased to hand over to my colleague Almila to begin the webinar proper.
Thank you, Dan. Good afternoon, everyone. I'm Almila Arikan Sarbanoglu, and I'm the head of Payables Finance here at Demica. Today, I'm joined by two valuable guests from Sullivan and Worcester, and now I will let them introduce themselves.
Hello, everybody. I'm Geoff Wynne. I'm a partner in Sullivan and Worcester, and I head the London office and our trade and export finance practice. And over the years, I have been and continue to be a strong supporter of supply chain finance.
And good afternoon, everybody. I'm Sam Fowler-Holmes, also a partner in the London office of Sullivan and Worcester. I specialise in the full range of trade, export and commodity finance products, but a huge part of my practice is in receivables finance and in particular in payables finance.
Today's webinar is about the future of payables finance. Together with our guests, we will look at the new disclosure requirements from a business perspective, and our commentary will be for discussion purposes only. Before we start exploring the future, let's take a look at our past and remind ourselves of a number of events that brought us here today. The names I will call out are those that I expect all our audience to be familiar with. Going back to 2015, the Spanish engineering giant Abengoa made the news and put payables finance in the spotlight. The company experienced significant financial difficulties, but what's important for us is that they were running a large-size payable finance program. According to the financial analysis by Moody's, a considerable part of Abengoa's trade payables, around 2.2 billion euros, was related to their payables finance program, with unusually long payment terms, reported as 219 days in 2014. Moving into year 2018, a household name this time, Carillion, collapsed, again putting payables finance in the spotlight. They were also operating a large-size payables finance program. Its volume reached about £500 million through its life cycle. The payment terms to suppliers were at 120 days mark, reported to be unusually long compared to the market terms. Also, costs related with the program were borne by the company. And the last name to call out, not directly related to the disclosure topic, but still relevant for us, is Greensill. Time will tell what the real problems were with Greensill, as they were involved with a variety of financial structures. But without a doubt, their demise dragged payables finance into the headlines again and shone the negative light on the industry. These programs, in particular Abango and Carillion, had been identified as structures with debt-like features, and it was possible to hide those in the lack of transparency. Indeed, it was possible to keep some unusual practices in the dark until they have surfaced and been publicly discredited. Following these, what I would call impactful events of Abango and Carillion, in October 2019, the US Financial Accounting Standards Board, FASB, received an agenda request from practitioners, mainly the Big Four, asking for guidance on disclosures that should apply to payables finance programs. This was followed by Moody's submitting a similar request to IFRS Interpretations Committee in January 2020. Since then, both authorities have been working with investors, accountants, and other users of the financial statements to determine an agreed scope and guidance around this matter. And first authority to issue their new disclosure standards has been FASB. At this point, I would like to ask a question to my colleague Sam. I think before we start exploring the new rules, we should set the scene from a legal perspective as well. Please, can you just briefly talk us through payables finance from your own point of view?
Thanks very much, Almila. I think just before I do that, I think there's the question that we have to also address is, given that the circumstances you've just outlined, then going back to 2015 with Abango, why has it taken us so long to get where we are today? And I think that underlines part of the background setting that we'll move on to on the next slide, which is that there are a huge range of participants involved in these programs, from the parties themselves, the buyer, the financier, the suppliers, through to the equity investors, the debt investors, the regulators, the ratings agencies. And all of these participants bring with them different views. And you touched very tellingly on how a number of the issues underlining all of those three big events that have occurred over the past decade, how they had practices involved that were not what I think you, Geoff, myself, and all of those on the call would probably see as being payables finance. And that's been part of the tension that we've seen in the market, is that there are always going to be products that are misused or used in a way that would be seen as pure products in the way they're intended to be used. And that tension has created a significant divergence of views between particularly regulators, auditing companies, ratings agencies, and many market participants who this is their day-to-day, have detailed knowledge, and who can point to things like the pandemic we've just been through as demonstrating that these are robust products that have survived well. And one of the regular accusations is these are uncommitted lines, they can be pulled at any time, investors need to know about this. Technically that is true, but I think, as I say, that is not how the market's developed. The pandemic, which would have been a time that you might have seen these facilities being pulled, that was not the case at all. So that inherent tension, I think, has played a big part in why it's taken us so long to get to here, whilst also obviously acknowledging that this is not a simple process. And FASB have themselves noted the processes they had to go through, including the consultation paper, the review of that takes time. But with that sort of background setting, if we can move to the next slide and just keep the focus on why it is that participants are looking to do these programs, because the idea is that there should be benefits for all involved. And I'm looking here at the buyer, so that's the receivable debtor, the one who owes the payable. Then you've got the receivable seller, so the owner of the relevant receivable, and then the financier, the receivable purchaser. From the receivable debtor perspective, I think the first bullet point is the one that we will touch on potentially as being perhaps viewed as more controversial circles than others. But this is, you may well be able to get better payment terms with your seller if you have this type of program in place than you might otherwise be able to have. But very importantly, and this really is a key objective, and again, touching on the experiences through the pandemic, it's supporting sellers, shoring up supply chains, because that is vital for debtors. Without having sellers who are able to continue performing, they simply won't be able to themselves perform and that will obviously result in a loss of revenue. Operational efficiencies and of course working capital benefits for the debtors. If you put yourself in the seller's shoes, very often they're able to leverage better pricing, better access to liquidity and funds than they would if they were doing perhaps just a typical receivables purchase arrangement, or if they were going to seek financing under another product. They're able to leverage off the back of the credit rating of the receivable debtor. There's balance sheet management and working capital and cash flow benefits for the seller as well. And then from the financier's perspective, there may well obviously be, there's going to be a profit element to this from having these programs, but very often it's having exposure to short-term good quality assets, often relationship products, so it's part of a package of financing that financier may make available, and being able to offer a diverse portfolio. So there are clear objectives which demonstrate that inherently there are benefits to the parties being involved here, and there is nothing necessarily flawed or to be concerned about in the product per se, notwithstanding the view there is of this product. If we can move to the next slide, please, Dan. And then I think this is one of the thorny issues that we've seen come up again and again during the past decade, which is the tension between the so-called trade debt versus bank debt. And this comes into very much the question of how should a payable under a payable finance program be treated? Now, if you're the financier under this type of program, what do you want to achieve? And the answer to that is typically you want an independent payment undertaking from the debtor that says, I will pay you, financier, on the due date of this receivable without set-off, counterclaim, etc., etc. And often they will even go further and say, and even if that receivable is something, that was not a true receivable or non-performance, whatever it might be. I mention that because it is a subset of that question, and it may well be something we can explore further. But you will see that part of what FASB has been trying to deal with is this range of views, and there are certain participants in the market who are of the view that these types of arrangements, with or without extension of payment terms, have, as you said, debt-like features and should be treated as bank debt rather than trade debt. And I think that's quite a strong position to take, and certainly one that is not shared universally at all. And it does have a significant impact for all involved, but particularly the debtors, because if you start treating accounts payables as being bank debt, you then start having to look at things like financial indebtedness ratios, how that interacts with other products. And you do have to ask that question, which we say here is, does it matter who the holder of the invoice is? If it's a trade payable when it's due to the seller, should that change simply by virtue of the owner of the receivable has become a financial institution or an alternative type of financier rather than the seller? And this is part of what the market is trying to grapple with, is how do you resolve this? We've sort of suggested some various solutions here, but I don't want to touch on those any further because I think there's more points we can sort of bring out of this. And I think what I'd like to pass over to you, if I could, Almila, is just to talk us through see how FASB decided to try and resolve those various tensions.
Okay, FASB issued the new disclosure rules update in September this year. In their update, they specifically mentioned the following. So they're expecting a buyer in a payables finance program to disclose sufficient information about the program to allow the user of the financial statement to understand the program's nature, activity, and change during a period or across different periods and the potential magnitude. To achieve that, the buyer is expected to disclose qualitative and quantitative information about their payables finance programs. Let's start by defining the scope here. So according to FASB, a payables finance program will have the following main elements. There will be a buying entity having an agreement with a finance provider or an intermediary to establish a program. A buyer confirming the invoices as valid to the finance provider or the intermediary, and a supplier having the option to request an early payment from the party other than the buyer themselves. As part of this review process, FASB has identified but then determined that they will be excluding a number of adjacent structures from the scope. as these structures do not have one or more of these main elements described, or they already are expected to be disclosed based on some other accounting provisions, they have been excluded from the disclosure requirements related with Payables Finance. Moving on to the guidance point, there are two main aspects to disclosure requirement, as we have just briefly touched upon. One is qualitative and the other one is quantitative. So this information is expected to be presented in the notes of the financial statements of the entity. So now we will take a look at these requirements with a worked example. Part of the qualitative disclosure requirement for the corporate is to provide the key terms of the program, including a description of the payment terms and any guarantee or other forms of security provided, together with the balance sheet line item in which outstanding confirmed amount is presented. Here, I would like to emphasize the word key. Given there are various implementations of Payables Finance programs, the use of the word key hands over the responsibility of determining what is key to the corporate, to assess the terms and conditions of their program and decide on what should be disclosed to satisfy the requirement. For our hypothetical example, we have considered a number of facts. This illustration is how a buyer might apply the guidance to disclose the key terms of a Payables Finance program with the following facts. ABC PLC, let's assume, a corporate, decided to operate a Payables Finance program funded by a new bank with suppliers in 5 different jurisdictions. New bank determines a facility size, but does not advise ABC of this information. ABC and new bank sign an agreement with an irrevocable payment undertaking that states ABC will be paying the new bank for the invoices their suppliers requested early payments for, using new bank's platform. There will be a 90 days notice for termination for either entity, and this is a standalone facility with no guarantee or security required. Only a one-off implementation fee is to be paid for the setup. New bank and ABC suppliers also signed separate agreements to govern the early payment requests, and ABC has not been party to this conversation or to this piece of work, and the payment term of the invoices are 90 days. Now let's take a look at the roll forward of the obligations, which is part of the quantitative disclosure requirements for the corporates. This is to provide numeric information on the obligations, or if we were to use a daily language, invoices that have been made available as part of the program for suppliers to request early payments for, and the change in these numbers within the reporting period. This starts with disclosing the confirmed obligations at the start of the year, followed by invoices confirmed during the year, and then the value about confirmed invoices paid in the year, resulting in the outstanding balance at the end of the year to become the carryover figure to start next year. Speaking of the reporting periods, the buyer is expected to disclose the qualitative and the quantitative information in their annual reporting. And for the interim reporting, they are expected to disclose outstanding confirmed amounts. These requirements are effective for fiscal years beginning after 15th of December 2022, literally next week onwards, including interim periods. This is the exception of the roll forward information, which we have just touched upon, which is effective for fiscal years beginning after 15th of December 2023. And during the fiscal year of adoption, the key terms of the program and the balance sheet representation of the obligations, which are annual requirements, are expected to be disclosed in each interim period. Just to put things into context, we are yet to see the IFRS accounting standards amendment from ISB based on their requirements. However, if we were to look at the main points in their staff papers discussed during their November board meeting, we can say that the rules on both sides are mostly aligned, maybe with some differences. An important point to make for both authorities is that they are both focusing their efforts on tackling the disclosure issue, not necessarily the balance sheet or the cash flow representation of Payables Finance. The reasoning behind this is explained as, regardless of where they are represented on the balance sheet or cash flow, obligations that are part of Payables Finance programs will be subject to disclosure going forwards.
So, Almila, I mean, that was a very succinct overview of obviously all the hard work that FASB has put into these rules, and we now know what it is that they are proposing and saying, at least as this initial step. So I think obviously the question that then naturally follows then is, what do you think about what they're proposing?
From a platform provider standpoint, we believe that it is vital for our industry to take the appropriate measures to improve transparency. We know that some corporates are already disclosing their programs, mostly the qualitative aspects perhaps. For example, a leading European frozen foods company, Nomad Foods, had information regarding their program in their 2021 annual report. But as also stated by the accounting boards, in the absence of disclosure standards that is applicable to all, the information corporates provide about their programs may vary, which means that it will continue to make it difficult for financial statement users to work with comparable information across periods for a corporate or across different corporates for them to form an industry view. Therefore, we welcome the news. However, we just need to ask ourselves a fundamental question of whether this is sufficient to put all the lingering doubts away. I'm sure everyone is more or less asking themselves a similar question, but I would like to start by saying yes. The rules will definitely move us into a different plane of clarity, because in principle, going forward, the program data will be available for the investors to use and arrive at their own conclusions. The financial analysis may continue to focus on some worst case scenarios, such as change of appetite by the financier or withdrawal of the program, to assess the potential impact on working capital and liquidity on both corporate and their suppliers. What we want disclosure to achieve is to help avoid impulsive reactions to isolated events, so that we can hopefully appreciate Payables Finance for what it is meant to be. I would say an alternative source of liquidity, rather than calling it the culprit of a corporate going bankrupt when there may be various other reasons for that to happen. I hope we can all agree that the problems with the cases we have discussed, such as payment terms being longer than the industry average and so on, are not necessarily inherent in every Payables Finance program. Disclosure is what will make these rather unusual traits visible, so that we will be able to identify a well-structured program, perhaps from a not so well-structured one. But I would caveat my initial response yes with the following, that we should obviously see the rules in action first. We are just about to start seeing that. As in time, with all the new things, there may be the opportunity to review, and if there is a market demand for it, there can be the possibility to enhance it even further. So Payables Finance, on the other hand, if we just look at Payables Finance demand, is reported to be growing by 36% per year. With the new rules in place, we expect all corporates to review their programs, and some may decide to make some adjustments before they start disclosing. And perhaps some of the more marginal deals will not get done, but we expect the growth sentiment to remain, and we don't see it significantly undermined. If I can also provide some points from the feedback that we have received from the industry, maybe it will also be helpful. This update is welcomed by most of our stakeholders based on the conversations we've been having, and it is widely agreed that the new rule is a step in the right direction. For example, one of our bank partners stated that corporates started to ask questions they were not asking before, so the new rules are certainly creating a new conversation in the market, which is positive. On the other hand, another business partner mentioned to us that they think disclosure may result in some participants reconsidering the use of the product. So that's the view that we have been seeing so far. Maybe at this point, it might be worth me asking Geoff for his views on the same. So perhaps you can just, let us know, Sullivan and Worcester's views on the changes.
Thanks, Almila. Good afternoon, everybody. As I said at the beginning, I'm a very strong supporter of supply chain finance. And as we've explained in our slides, having supply chain finance, particularly with the payables end, has great advantage to everybody in the marketplace. Payer gets an advantage, supplier gets an advantage, and financer sitting in the middle is able to receive a reward for what it's doing. I have to accept that, given the examples that Almila has done, given the drive for transparency, that it is quite right that there should indeed be transparency. And clearly what has to go with transparency is disclosure. But the issues that we have are exactly what do you have to disclose, in the sense that, as you have said, Almila, and is being said, that it is not the fact that the obligation of the buyer is not already on its balance sheet, shown either as trade payable or, as those would argue, because it looks like bank debt, it should be shown as bank debt. So the question then is there another category of trade payable that this is addressing? Or are we saying that all trade payables have to be disclosed? And I think that the definition points that have been raised, which is what people are discussing, is saying surely not every payables transaction that I as a corporate have is disclosable. Because if it's just an invoice and it's discounted and then maybe set up or whatever, presumably I don't have to disclose that, because the key element being questioned is there an IPU? In other words, is there an irrevocable or independent payment undertaking? And it is only that element of the trade payable that needs to be disclosed. What happens if I have an arrangement as a buyer with a financer that simply says that the financer will pay my payables as my agent? Is that disclosable? So we need eventually to make sure that we do hone in on what is absolutely key that needs to be disclosed in a different way. So the information disclosure then becomes important. And that gets you to what level of disclosure is required. Do I have to disclose confidential terms about how my payments are being made? If my payments are extended beyond the norm, let's say more than 90 days or more, then you can begin to see that it has, as Almila, you said, the debt-like quality, and consequently financiers might then be concerned about what's going on. But from the corporate's point of view, it needs to know, do I have to say everything about the level of discounts that might be being offered? Because that is going to affect my competitiveness in my marketplace. If I have to reveal in my accounts all the terms that I am getting for my payables programs, which others may then emulate. So that's the issue that I am assuming that the request and the requirement that buyers will have is to disclose the minimum that might be required under FASB and then under ISB. And I think on that basis of clarifying what has to be disclosed, then you get to the point that the benefit of disclosure should not outweigh the cost of achieving that disclosure. And I think at that point, a platform like Demica may well be able to turn and say, look, we can work out how you can efficiently deal with cost. I think, I mean, that's a point for you to take on that, please.
Yeah, actually, it is very relevant to talk about the costs associated with disclosure, like you have mentioned, Geoff. The accounting boards also acknowledge that disclosure may lead to additional cost for corporates if they have to maybe enhance their systems or change their reporting processes just to make sure that they have the relevant information at hand. We know that some corporates are already disclosing the required information, so we know that it is doable. Also, platform providers like Demica can play a role in here. Obviously, from my perspective, as I work for Demica, I can only talk on behalf of Demica, but I expect other professional platform providers operating in our market to be able to help corporates with the information required for their disclosure. Therefore, we expect the cost implications on the corporates to be minimal. That would be our. Right. It just feels like the prep work that we have done in order to have the first part of our webinar has come to a natural end. Perhaps if you both agree with me, we could now open the floor for questions from our audience. Okay, so we have a question submitted from one of our participants. Is there a difference in approach proposed between the programs where suppliers' receivables are assigned and the pure buyer-led corporate payment undertaking type of structures? Perhaps, as you know, I'm obviously not trained to be an accountant, and the perspective I can provide will only be from a business point of view. However, I would say that if we look at what FASB has also mentioned as part of their documentation provided, they are clearly stating that all the factors that are part of the program should be taken into consideration to decide whether that particular program fits the definition of a program that should be disclosed or not. I believe there are some main elements that they have identified, and there are some indicators that they have identified. But I think the guidance is that if you have something that looks like a Payables Finance program, it makes sense to discuss all aspects of it so that a clear judgment can be made with respect to whether it is subject to the disclosure rules or not.
But it's a nice question, isn't it? It's a slightly nuanced question.
Yeah, absolutely.
I think the starting point, if you like, in the answer is that there has to be a buyer-led program. It has to be payables, and yeah. I think, funnily enough, there has to be a program.
Yeah.
So, as Sam was saying, yeah, our work ranges from buyer-led to supplier-led. If there is a supplier-led program, that is it's not reportable by the supplier, and the fact that the supplier has multiple buyers does not mean necessarily that any buyer in that program, if you like, has to report. But presumably, and this is sort of back to Demica, if you set up a program, even if it were supplier-led, but buyers are joining that program, is that going to bring that program into FASB from a buyer's point of view, never from the supplier's point of view? That's what we've got to think about. Is that wasn't meant to put you on the spot, but it's an interesting thought as to how you get into what the concern is that FASB and ISB are looking at, is what are buyers doing in just their normal assistant to a supplier? Why should that be reportable? And I think we're going to help people look at exactly whether there is a reportable program when it's clearly supplier. I don't know if that helps the questioner, but yeah, this is one for discussion going forward.
Yeah, I think the main elements of how FASB looked at payables finance programs was that they were expecting the buyer to have an agreement and with the finance provider, and underneath that the buyer is expected to confirm invoices as valid and make them available for their suppliers to ask for an early settlement. And if we just follow these main guidelines, then as long as a program actually ticks these boxes, I would expect that to be subject to disclosure. But again, this is just a business point of view, and I believe each and every company who are in this position that they have a program of some sort live at the moment would be doing this test, maybe just checking these items against how their program is. Like we have mentioned the term key, haven't we? So they just need to look at the key aspects of their program, and whether it actually fits the bill, then that potentially is where the conversation should start. But I don't believe that FASB has been very restrictive with respect to it is only these 3 rules and that's it. I think they are also putting the onus on the parties to say, just take a look at the entirety of that, what that program looks like, and if you believe that it is something that fits this definition, then there is no harm in disclosing.
But it's a buyer-led program. The program has got to be buyer-led.
Yes, that's right. Right, because the buyer at the end of the day is expected to disclose, and they're expected to confirm the invoices as valid. So when you consider that perspective, we can agree that we're looking at buyer-led propositions here. And
the second bit on that, there has to be a finance provider.
Mm-hmm.
So what Demica is doing on its platform, if your platform is available just to a buyer, that is not in itself a disclosable payables program. That's my thinking.
Mm-hmm. I believe one of the items that needs to be looked at is that the suppliers in a payables finance program, in the way that it's been defined, should be able to ask for an early payment from a party that is not the buyer. So in this particular occasion, I would like to think that you just need to have a financial institution or some sort of intermediary in and provide the financing, and that will be one of those tests that needs to be applied to the program to decide whether it actually fits into the scope of disclosure or not. Because one of the main elements that we have discussed was about the suppliers having the option to request an early payment from a party other than the buyer. In this occasion,
that's exactly the point, and that's part of the discussion. Is if the supplier can request early payment from the finance provider through the platform, does that make it a reportable payables program from the buyer? And I think there's a strong argument that says it's not. If all that the buyer is doing is having an arrangement with a bank under which the bank, against, if you like, an IPU, makes the payment, but it may decide to make it early to the supplier. Is that a reportable program? And I don't think it's clear. And I think that's what there's going to be some discussion around. I'm sort of slightly hogging this. So have we got, I think we have some more questions.
Actually, there is one more question that I have received from our audience. Our participant is asking if I am the anchor and if I follow the new disclosure requirements, will my trade payables has less or zero risk of being classified as debt, or the new disclosure is nice to have but does not change the reclassification risk?
Would you like to take? Yeah, I'll take briefly, because I think, and actually I can see we've had a few questions, and it's clear coming back to this trade debt, bank debt, how do I report this? What's the impact of these rules? And actually, if you read the accounting standards update that FASB have produced, you'll see that they basically try to neatly sidestep this question, because what they say is it's almost one step at a time, and the first step is there is a lack of transparency, and what we are being asked to do, and quite frankly what we can achieve within the time that they wanted to get something out to investors, to the market, is our rules about how you present information regarding these programs. And if you sort of delve through it, what you'll see is they're actually saying we're not making expressing a view on the nature of these, and they do expressly say that stakeholders, the range of responses were to two of the questions we've had, that some stakeholders clearly see these programs as just being outside of accounts payables, that these are debt arrangements simply because you have a financier involved. There were other stakeholders who clearly were promoting the view, which we touched on a little bit earlier in my opening sort of slides, which is if I agree extended payment terms, and you have to ask the question, does that only apply if it's extended payment terms offered by the financier, so between the financier and the debtor directly? Or is that if I'm the supplier and the buyer comes to me and says, look, I've got this great program, be involved in it, but instead of doing 90-day payment terms, I want 120, and I as the seller say, that's fine, I'm happy to do that because I can be in the program. You raised the question, are those two scenarios different in the stakeholders' view, or is one acceptable, one not? And what FASB says is, look, there are rules out there and other parts of the accounting standards that you need to be aware of. We're not going to necessarily tell you what they are, but you need to be aware. And if you think that your program would be reportable under any of those standards, this shouldn't change how you report. This is in addition to that. But I don't think at this time, and this is one of the things that we're going to have to carefully monitor as these rules are implemented, or these standards are implemented. At this present time, they are not saying anything about the judgment you should make about having this program and whether or not it should be reported differently in terms of whether it's an account payable. And they expressly say they're not looking to disaggregate this type of account payable from that one, They're saying this is about transparency about the program. If you think there is anything that should be treated as debt and would be reportable as debt under other accounting standards, as you rightly said, Almila, they say it's on you debtor, it's on you buyer to make that decision. And that runs throughout in that you gave the very good example of qualitative and quantitative, but it's very clear from this that they are saying it's up to you to decide what the key terms are, and it's up to you to decide how much you have to disclose to satisfy these requirements. And that's what obviously is going to be the real test for everyone doing this, is how do you satisfy it? And we won't know that until it's being implemented. But hopefully that sort of covers a number of the questions we've had, which I think are very rightly focused on. How does this mean I have to report programs from a sort of an accounts payable line, or a trade debt, or a trade payable bank debt line?
Mm-hmm.
And let me just add, Sam, that was a really good summary of it. But just in relation to that question, that we're talking about transparency of a payables program, and it is quite right, because I'm a strong supporter that you should not be converting trade debt into bank debt simply because of this program, that it is right to say that we are not, and we should not be being forced, and therefore buyers should not be forced into changing the characteristic of this payables program into bank debt, and therefore affecting all sorts of other ratios. And I'm hoping that FASB and ISB, and consequently auditors, will take that view that this is about transparency of a payables program, not about the extension of financial indebtedness, i.e. bank debt. And that, if you like, is a key message. I would
Yeah.
like to take away.
No, I agree with that, Geoff, and I think you are making a very valid point. And I think both authorities have also made it very clear that we are not giving you information with respect to how you should be classifying these at the moment. We are telling you that if you have a program, these are the things that we expect you to disclose at a minimum. If you would like to go beyond that, it's up to you to decide, because we are telling you that the word key is important in here, and you look at your program, you disclose what you think is meeting the requirements, which is very clear. But they are both authorities, as we read from their documentation, are specifically saying that we are not addressing the reclassification issue here. It is not the purpose of these changes we are introducing. We just want to make sure that there is transparency and more clarity around the magnitude of these transactions, so that the users of the financial statements can use this information and just do their own analysis based on their own judgment. I think we have also, by way of going into this, we have also been able to perhaps respond to another question that we have received. So I'll just, very briefly touch upon that. This is Annie from FAB. Once corporates have the knowledge of the amount confirmed, as a natural extension, can auditors then say, you know how much you owe the bank? So now you report it as debt. Today, the clients don't know how much it is financed by banks, and this is governed bilaterally between bank and the supplier. So just to clarify in here, FASB in their document mentioned that they will not be looking for information on how much of those confirmed invoices have actually been utilized. So the suppliers, if they are asking for an early payment, that amount is not necessarily asked as one of the requirements to disclose. I believe that the disclosure we're talking about in here is the invoices that have been confirmed as valid to the financial institution or to the intermediary, rather than how much of that is actually discounted. So I think there is a part in the document that clearly talks about the fact that they won't be asking this information to be disclosed as part of the requirement. So maybe that's also a helpful point to make. Another question that I would like to look at, is there feedback you can share from the analyst community on the changes? The big concern from a corporate perspective is the fact that these outstanding amounts could get added back for computation of leverage ratios. I believe that the purpose of disclosure is to provide the information so that every user of the financial statement can use their own judgments, can assess the information provided, and then they can just decide on what extra computations or calculations they would like to make, and arrive at a conclusion for themselves. I believe that the possibility that we are trying to avoid in here is just because of lack of transparency. There will be perhaps the way to look at it is just for the sake of doing the right thing, maybe, or just from a protection perspective, let's consider all of this is in one way or another. I think the information that's going to be provided will hopefully give more that the investors were looking at, to be able to say, I would consider this in this part of my calculation or in another part of my calculation. Well, from a Demica perspective, we do not have any information from the analyst community at the moment that we would be able to share, so apologies for that. I wonder whether Sullivan and Worcester has any information that they can share, but our understanding is that the idea is to disclose the information. And as long as the information is there, the user of the financial statement will determine for themselves how they would like to use this information, and how they calculate their ratios will be subject to their own interpretation.
But I think that the sting in the tail, just to go back, because when people talk about ratios, I want to try and avoid the natural assumption that this is a financial ratio and therefore it's a debt calculation, because what we're talking about here, and you actually use the phrase confirmed or invoices confirmed as because that's really the point, because we're talking about a buyer who by definition has trade payables, because he's buying something. There are invoices that he has to pay, and as we strip down the buyer-led side, the fact that he's got invoices which he pays, suppliers could actually discount those invoices without the IPU, without the confirmed part. The fact that a buyer confirms shouldn't change the nature of the fact that it owes under invoices. And I think the information disclosure then says, okay, so he's got a payables program. Under that payables program, there's a certain percentage of his invoices that are confirmed. They should, at that stage, simply still be trade payables. That does not, the fact that a buyer says, I'm going to pay, should not in and of itself turn that into bank debt. And what we've always said as Sullivan and Worcester is, and the fact that that confirmed payable is held by a financial institution or a fund does not change, should not change the nature of it, should not become bank debt when it was still trade payable. This is about information being made available, transparency, not about creating a huge amount of bank debt, which isn't bank debt. Sorry, I bang on. It's one of the key bits that that I think we need to be, everyone needs to be concerned about.
Thank you very much for that as well, Geoff. There are a few questions that we are getting from the audience that is related with whether the rules are different or do they still apply when it is a pure payables finance program versus it is maybe a dynamic discounting program, which I believe we have partially addressed it as well. But again, going back to what the disclosure rules apply to and how the program itself is defined by FASB, I think the ability of a supplier requesting an early payment from a party that is not the actual buyer, the party that is confirming those obligations, is one of those key elements that is defining the scope for disclosure. Therefore, I would think from a personal point of view, mainly, that the dynamic discounting structures in the traditional sense that we are seeing out there in the market tend to be buyer using their own cash to finance the suppliers themselves. I would like to think that that structure in particular is not necessarily ticking this box, but like I said, it is just a personal view, and I'm sure the auditors will be in a much better position to assess whether that particular program is the one to disclose or not. But I would like to think that the test to apply in here to a program is obviously how the main elements have actually been described by the board. But at the same time, like we have said at the beginning, FASB is making it very clear that look at all these parameters, but at the same time, look at the rest of your program and what's the entirety of your program and its key components look like, so that you can decide whether this actually fits the bill, and then you should then disclose. That will be my take. Any further weaves from your end on this matter, dynamic discounting versus payables?
I think what you said is absolutely right, but I would just remind the audience, as you opened this webinar with where the problems were, is that we should remember it was abuse of the use of buyer-led programs that led to the intervention, and that therefore we shouldn't think that every single buyer-led program is something bad, is something reportable. Because I think somebody made the comment, does that mean that all of this becomes bank debt? And that was the whole point. No, it didn't. And the fact that you report your program, and it has to be a buyer-led program. So if this is supplier-led, it's not reportable per se. It's what the buyer is agreeing to do within the program that makes it reportable. That's certainly my take on this.
Thank you very much for that. I believe there is just one more question in the remaining few minutes that we have that we might try to address. I think we have responded to most of them in one way or another. So the question from our audience is, are there different approaches planned in terms of accounting treatment or disclosure requirements for programs with extended payment terms versus those with unchanged payment terms? I think the message will be very, very, very similar in this occasion. I believe looking at how the scope has actually been defined by FASB and looking at the entire program and its key features, a decision should actually be made. I believe with or without payment extension, if there is still an agreement between the financial institution and the buyer, and there is still a confirmed invoices that is sent to the financial institution that will be then offered to the supplier for an early payment, it can still fit the definition of a payables finance structure. Therefore, it may still be disclosed. I think the gist of the matter is the scope has been defined, and then it has some certain elements to it that needs to be looked at. And for each and every program, I would expect, as we have mentioned, that there are various different implementations of payables finance when we just look at the industry. But I think the test is whether my program has these features, and if it does, then probably we're looking at disclosure. I would think that the scope is going to be the leader of this discussion in here that needs to be checked against the programs that the buyers are running at the moment.
Good answer, great question, because there is this point that
yeah,
if you've just got a payable that stays as it was, what's the mischief if those are normal terms? But I think that's not yet been addressed. So theoretically, if your invoices are payable after 30 days, but you sign a program, it's reportable. But there's no particular harm, and I think that's the point. The fact that you report it, because that's what it says, should in absolutely no way change its nature. It's just a short-term payable.
Thank you for that, Geoff. I believe we have been able to cover all the questions that we have received from the audience, so we are very happy about that. So if I may, ask our panel maybe to share with me their closing comments, I would be happy to hear it. I'm sure my audience will also be.
Okay, I'll go first then quickly. I think, I think this is in many ways a long time coming. Very difficult, I think, for anyone in the market to challenge transparency. And I put it the other way: people who don't want transparency, there is often sort of a view as to that there's something to be hidden. But I think it's going to be these next few financial reporting periods that I think are really going to demonstrate whether FASB have got this right, because there's going to be a learning process. There definitely shouldn't be transparency for transparency's sake necessarily. I don't think we should be adding more burden with no benefits, and clearly FASB are alive to that when they talk about cost benefit. But I think my cautionary note is that whilst I am sort of open and welcome in many ways the transparency and the way they've approached things so far, is that there is always that with this snowball more, so that we could do this webinar in a few years' time and be talking about a very different set of accounting standards, a very different set of obligations, and many of the concerns that the participants in the audience have been raising. I know that there is clearly a portion of the market that would like the answer to some of those questions to be, yes, you should be reporting this as bank debt. Yes, you should be treating it differently. And I think that's where it's us as all the market participants to make sure we're stress testing these standards and ensuring the feedback is given at the level, because if we don't, those who are most proactive will ultimately get what they want, is my view. And often those who don't like what's in there will be the quickest critics and the quickest to propose new things to be done. So I'm open to where we are, but let's see how it's implemented, and let's keep alive to the dangers of that kind of mission creep that could occur.
Thank you, Sam. Is there anything you would like to add from your end, Geoff?
Not really. I mean, Sam said it. Transparency and disclosure is fine. Don't let the fact that there's going to be transparency, there's going to be disclosure, be abused, and therefore make buyer-led programs become undoable because somebody is reinterpreting the whole framework of the payables obligation of a buyer. Let's keep fighting to keep it straight.
Thank you very much. And from Demica's perspective, we believe that it's about time we started a positive conversation on payables finance, as the negative references attached to the isolated examples that we've talked about. I believe it's made it possible to question the validity of the whole, and we understand that, but we should also recognize, like you have mentioned, Sam, a few times, that during the pandemic this product was a source of lifeblood, I would think, and especially in today's uncertain environment, what we are seeing is more companies are turning to payable finance arrangements to help them accurately and effectively manage their liquidity and cash flow, and we only expect this adoption to grow in future given the economic outlook remains to be challenging. So we are hoping that the transparency that is expected after the rules come into play will be achieved, and it's going to be producing us the results that we would like to see, so that we will have more information that we can work with, and we will be able to hopefully say that we now can see these unusual trades, so that we will be able to see a well-structured deal from a not so well-structured deal, and then we will be able to see payables finance for what it is meant to achieve. On that note, we would like to thank, first of all, I would like to obviously start by thanking our wonderful guests. Thank you for sharing your views. Thank you for sharing your very valuable insights with me and with our audience today. And also we would like to thank our audience for just sparing an hour of their time today and be with us. Thank you very much for all the questions that you have submitted. I hope we have been able to give you a perspective on these disclosure rules, and we will be hopefully welcoming you to more webinars that we will organize in near time. I'm hoping that you have a wonderful rest of the afternoon.
Nice finish.